In the rolling hills of rural Pennsylvania, where farming families had worked the same land for generations, John Rigas saw something others missed. While his neighbors worried about crop yields and cattle prices, Rigas looked at the television antennas struggling to catch signals from distant cities and recognized an opportunity that would eventually corrupt his soul and destroy his legacy. It was 1952 when this son of Greek immigrants borrowed $300 to purchase a cable television franchise in the tiny town of Coudersport, Pennsylvania, population 2,500. What began as a simple solution to bring clear television signals to remote communities would evolve into America's fifth-largest cable company, built on a foundation of lies, theft, and family greed that would ultimately steal over $2 billion from investors and employees alike. John Rigas understood the cable television business from its earliest days, when it was nothing more than large antennas on hilltops connected to homes by coaxial cables. Throughout the 1950s and 1960s, he methodically expanded his small Pennsylvania operation, acquiring neighboring cable systems and building new ones in rural markets that larger companies ignored. Unlike the flashy entrepreneurs who would later dominate the telecommunications industry, Rigas presented himself as a humble family man who never forgot his roots. He spoke with a slight Greek accent, drove modest cars, and lived in the same small Pennsylvania town where he started his business. This carefully crafted image of the down-to-earth businessman would later prove to be nothing more than an elaborate disguise hiding one of the most brazen corporate criminals in American history. By 1972, Rigas had incorporated his growing empire as Adelphia Communications, taking the company name from the Greek word for brothers, symbolizing his intention to build a family business that would last for generations. The 1980s and 1990s transformed the cable television industry from a simple utility into a high-stakes growth business, and John Rigas proved masterful at playing the expansion game. Adelphia went public in 1986, raising capital that Rigas used to acquire cable systems across the country, from small rural markets to major metropolitan areas. The company's growth strategy appeared brilliant to outside observers. While competitors fought expensive battles for customers in saturated urban markets, Adelphia focused on underserved rural and suburban communities where they faced little competition and could charge premium prices. By 1999, Adelphia served over 5 million customers across 32 states, making it the sixth-largest cable company in America with annual revenues approaching $4 billion. Wall Street analysts praised John Rigas as a visionary who had built an empire by understanding that rural Americans deserved the same quality television and internet services as their urban counterparts. The financial press regularly featured glowing profiles of the humble Greek immigrant who had created a telecommunications giant while maintaining his small-town values and keeping his company headquarters in tiny Coudersport, Pennsylvania. Behind the facade of steady growth and family values, the Rigas family had turned Adelphia Communications into their personal piggy bank, stealing money on a scale that would have impressed the robber barons of the 19th century. John Rigas and his three sons, Timothy, Michael, and James, who held key executive positions within the company, had created an elaborate web of off-balance sheet partnerships and subsidiary companies that existed for no purpose other than to hide their theft from investors, auditors, and regulators. These entities, with innocent names like Highland 2000 and Olympus Communications, borrowed billions of dollars using Adelphia's credit, then funneled the money directly to various Rigas family enterprises and personal expenses. The family used stolen Adelphia funds to purchase the Buffalo Sabres hockey team for $88 million, construct a private golf course, buy luxury condominiums in Manhattan and Colorado, and maintain a fleet of private jets. Timothy Rigas alone spent over $12 million in company money on personal expenses, including African safaris, luxury automobiles, and country club memberships for himself and his relatives. The scope of the Rigas family's theft extended far beyond personal luxuries into a systematic looting of shareholder value that manipulated Adelphia's financial statements for over a decade. The family created fake transactions between Adelphia and their private companies to inflate the cable company's subscriber numbers, revenue figures, and profitability metrics that determined executive bonuses and stock prices. When Adelphia needed to show growth in high-speed internet customers, the Rigas family simply invented fictitious subscribers and recorded them in the company's official reports to Wall Street, They inflated the number of homes passed by Adelphia's cable networks by counting the same residential areas multiple times across different subsidiary companies. Most audaciously, they recorded over $1 billion in construction expenses for cable infrastructure that was never actually built, pocketing the money while telling investors that Adelphia was making massive investments in network upgrades. These fabricated construction projects allowed the company to claim depreciation expenses that reduced its tax obligations while simultaneously borrowing against the fictional assets to fund additional family spending. The Rigas family's criminal enterprise required the complicity of Adelphia's senior management team and external auditors who either participated in the fraud or willfully ignored obvious warning signs that should have triggered investigations. Chief Financial Officer James Brown, who was not a family member, actively participated in creating fraudulent financial statements and hiding off-balance sheet debt that eventually totaled over $3 billion. The family appointed loyalists to key positions throughout the company, creating a culture where questioning financial irregularities could result in immediate termination. Adelphia's external auditors, the prestigious accounting firm Deloitte & Touche, failed to identify massive discrepancies in the company's books despite conducting annual audits that were supposed to verify the accuracy of financial statements provided to investors. Internal company documents later revealed that multiple Adelphia employees had raised concerns about questionable transactions and accounting practices, but these warnings were either ignored by senior management or resulted in the whistleblowers being marginalized within the organization. By 2001, maintaining the Adelphia fraud required increasingly desperate measures as the company struggled to service debt obligations that had grown to over $18 billion, much of it hidden from investors through off-balance sheet partnerships. The Rigas family had borrowed so much money against Adelphia's assets to fund their personal spending that the company lacked sufficient cash flow to make required debt payments while continuing to invest in network infrastructure needed to compete with satellite television and telecommunications companies. John Rigas and his sons began frantically shifting money between different subsidiary companies and partnerships, creating a shell game designed to confuse auditors and creditors about which entities owed money to whom. They delayed payments to equipment suppliers and construction contractors, claiming temporary cash flow problems while assuring creditors that Adelphia remained financially sound. Most desperately, they began borrowing money from pension funds and employee benefit plans, stealing retirement savings from the same workers whose labor had built the cable systems that made the Rigas family wealthy. The Adelphia fraud finally collapsed in March 2002 when the company disclosed in a quarterly filing with the Securities and Exchange Commission that it had guaranteed over $2 billion in loans to entities controlled by the Rigas family, money that investors and creditors previously had no knowledge existed. This revelation immediately raised questions about what other debts and obligations Adelphia had hidden from shareholders, triggering investigations by multiple federal agencies and causing the company's stock price to plummet from over $80 per share to less than $1 within weeks. As investigators examined Adelphia's books more closely, they discovered that the $2 billion in disclosed family loans represented only a fraction of the money that John Rigas and his sons had stolen from the company over the previous decade. The true scope of the theft included over $3 billion in off-balance sheet debt, hundreds of millions in fabricated transactions, and systematic inflation of subscriber numbers and revenue figures that had misled investors about Adelphia's actual financial performance for years. The criminal investigation into Adelphia Communications moved with unprecedented speed as federal prosecutors recognized that the case represented one of the largest corporate frauds in American history, occurring at the same time as the Enron and WorldCom scandals that had shaken public confidence in corporate America. In July 2002, FBI agents arrested John Rigas and his son Timothy at their New York offices, parading the cable television patriarch in handcuffs before news cameras in a scene that symbolized the fall of a business empire built on lies. Federal prosecutors charged the Rigas family with conspiracy, bank fraud, securities fraud, and wire fraud, alleging that they had systematically looted Adelphia for personal gain while lying to investors about the company's financial condition. The indictments detailed how John Rigas had used his reputation as a humble small-town businessman to deceive Wall Street analysts, creditors, and his own employees while stealing money on a scale that dwarfed most bank robberies and organized crime operations. Adelphia Communications filed for bankruptcy protection in June 2002, leaving creditors with over $20 billion in claims against a company whose assets were worth less than half that amount. The trial of John Rigas and his son Timothy in 2004 revealed the staggering scope of their theft and the casual way they had treated a public company as their private wealth source, showing complete disregard for the thousands of employees and investors who trusted them. Federal prosecutors presented evidence that the Rigas family had stolen over $2 billion from Adelphia, using the money to fund a lifestyle of extraordinary luxury while lying to shareholders about the company's financial health. The trial featured testimony from former Adelphia executives who described a corporate culture where the Rigas family felt entitled to spend company money on any personal expense they desired, from Timothy Rigas's African safari trips to the family's purchase of the Buffalo Sabres hockey team. John Rigas, then 79 years old, showed no remorse during the trial, maintaining his innocence and claiming that he had always acted in Adelphia's best interests. The jury deliberated for only 2 days before convicting both men on multiple fraud charges, and the judge sentenced John Rigas to 15 years in federal prison, while Timothy Rigas received 20 years. Michael Rigas pleaded guilty to lesser charges and received a suspended sentence in exchange for his cooperation with prosecutors, while James Rigas was acquitted of the most serious charges but faced civil penalties from the Securities and Exchange Commission. The collapse of Adelphia Communications destroyed the retirement savings of thousands of employees, wiped out billions in shareholder value, and left customers in rural communities wondering whether they would continue to receive cable television and internet services they had come to depend upon. The company's bankruptcy eliminated over 15,000 jobs and forced the sale of Adelphia's cable systems to competitors including Comcast and Time Warner Cable, who paid approximately $17 billion for assets that had been valued at over $30 billion before the fraud was revealed. Pensioners who had invested their retirement savings in Adelphia stock lost everything, while employees discovered that their 401k accounts contained worthless shares in a company that no longer existed. The scandal prompted new federal legislation requiring corporate executives to personally certify the accuracy of their company's financial statements, with criminal penalties for false certifications. Today, the name Adelphia serves as a reminder of how family control of a public company can enable massive fraud when there are insufficient checks and balances to prevent corporate executives from treating shareholder money as their personal wealth, and how the collapse of trust in corporate America can destroy innocent lives far beyond the executive suites where these crimes are planned and executed.